two people earn the exact same amount of money. One person invests in a retirement annuity and the other outside a retirement annuity. And one of them retires with millions more. Let's look at how this is possible. And as always, I'll help you establish a rule, which is what I call the 19-year rule when it comes to retirement annuities. So many people get retirement annuities wrong. And you know, I'm not one for just accepting that any investment is a good investment without some proper Excel sheets, some trade-off calculations, and some good investigation. So this is what this video is all about. The biggest misconception I see around retirement annuities is that because you get a tax deduction, it makes it a superior investment that triumphs all investments, which is not the case. So let's dig into this. The scenario I'm using is someone that's in the highest tax bracket in South Africa, which is 45%. This is relevant because as soon as you climb into the higher tax brackets, you feel pressured to use a retirement annuity to bring down your tax liability. So this high tax bracket that I'm using is almost like a best case scenario tax deductible that you can get by making an RA contribution. I'll also touch a little bit later on what exactly an RA is. So if you're not sure, don't worry. I'm assuming a 2.2 million Rand taxable income. This is after deductions, but before retirement annuity contribution deductions. So if we run this income through the tax tables, in South Africa, there's a marginal income tax bracket system, which means that as income increases, the tax on each bracket increases. And the total tax payable on this income would be 816,000. So retirement annuity contributions that are tax deductible is limited to 27.5% of your taxable income, up to a cap of 350,000. And in this case, we're assuming it's maxed out at 350,000. So we've got two people. Person one, who invests outside their retirement annuity in a normal brokerage accounts. So they've got no RA. Let's call them Nora. On the other side, we've got person two who loves an RA. And for this reason, we'll call them Ray. The next step is a little bit complex and not that easy to explain, but bear with me. What we want to achieve here is we want to put both Nora and Ray in the same cash flow position. This means if Ray pays less tax because of her RA contributions, that means she has more money to invest. On the other side, Nora is not using her retirement annuity tax advantage, so she is paying more tax. And that means she's got less to invest. Hopefully this table makes it a little bit easier to understand. Both have a taxable income of 2.2 million. Ray has an RA contribution of 350,000. That means her taxable income and tax payable is less because this deduction falls within her highest marginal tax bracket. Nora pays 816,000 of tax and Ray pays 660,000 of tax. That means Ray saves 157,000 of tax because of her RA contribution, and that's equal to her highest marginal tax bracket rate of 45%. On the other side, because Nora pays more tax, she's only able to invest 192,000. And remember, this investment is in a normal brokerage account, which allows her to invest in international ETFs. But I'll get to that point. The important thing here is that we want to get them in the same cash flow position, which allows us to compare apples to apples. Because the one pays more tax, she's able to invest less, and the other is able to invest more, but saves on tax. This chart also then brings in the tax refund to show you in a separate way the tax saving and how the tax saving gets them both to the same cash flow position. So Nora is only able to invest 192,000 outside the RA, and Ray is able to invest 350,000 in an RA. That's a significant difference, almost double. But here's where the good stuff comes in. With a retirement annuity, the investments have to be Regulation 28 compliant, which means there are limits around how much is allowed to be invested in equity and how much is allowed to be invested in foreign equity. On the other side, for Nora, she is basically free to do with her after-tax money as she pleases. This gives her the freedom to invest in an international ETF and go full-on equity if she wants. Regulation 28 on retirement annuity products means only 75% can be invested in shares, and only 45% can be invested in foreign shares. There are two reasons I don't like this. If you're a young investor, then you need to get maximum share or equity exposure, because when you're younger, you've got a long timeline ahead of you, and that means you need to take maximum risk in the stock market. And the second reason is, I don't like the fact that they're limiting foreign exposure. If these are your investments, I want you to pick and choose the way that you want to invest it. And now they're telling you can only have 45% international exposure. And this especially I don't like, because the South African stock market did not keep up with the international stock market. So now for our forecasts, we have to make some return assumptions. But before we do that, if you're wondering whether your retirement planning is going according to plan, then I've got a retirement calculator that you can use that will definitely help you see whether you're on track or whether you need to ramp up your investments. Follow the link in my caption if you want to download that. To do this forecasting, I'm going to use some historic data, which past returns don't predict future returns. But for assumptions, this is the best we can do, is to use past data. One thing I have to make very clear is that in even the case of a retirement annuity product, the return I'm going to use is assuming that you're not invested in a high fee retirement annuity product or going through an advisor that adds another additional layer of fees onto your investments. And the problem here is that you might look at this analysis and say, okay, actually, I'm not too bad off in my retirement annuity. But please just go and look at your returns and look at how it compares to the example I'm using, because this will hopefully allow you to benchmark the returns that you're getting after fees to the returns that you could potentially get in another retirement annuity product. The retirement annuity product, or this fund that is Regulation 28 compliant, the example I'm going to be using is the Signia RA Skeleton 70, which since inception, which was 2013, has returned 9.2% per year. So this is the investment Ray is investing in. Then Nora, we're assuming, is investing in an MSCI World ETF, which really is just a low-cost way to track the global stock market, and also a way of investing that I'm a big advocate of. In case you're new to this channel, definitely have a look at my other videos. This MSCI World ETF has, on average, returned 12.8% per year since inception. Then, of course, I'm going to bring an S&P 500 ETF into the mix too. And this S&P 500 ETF has returned 16.8% since inception. We're going to use these return assumptions. I have to remind you, these are just assumptions, obviously not guarantees. And we want to compare how Ray's RA investment grows over 30 years compared to Nora's MSCI World ETF. So based on these return assumptions, the RA has a value of 4.9 million over 30 years, and the MSCI World ETF, 7.1 million. If we look at the S&P 500 example, obviously this is going to be much more significant because the returns are quite a bit different. Then the RA, which is worth 4.9 million, compares to an S&P 500 ETF, which is 20.3 million. That's a significant difference. But of course, there are a few additional things that we need to consider, like tax. So a retirement annuity defers tax to a point in future. You get a tax deduction now, but the money that you receive in future when you retire will be taxable. The tax rates are more favorable on retirement annuities. But it's a little bit more tricky than that, because a retirement annuity will get paid out 1/3 as a lump sum, which has special tax tables, and then 2/3 as a living annuity, which also is taxable if it goes higher than thresholds. On the other side, investing in a normal brokerage account like Nora would mean that your investments would be subject to capital gains tax and dividends tax, but the majority of the growth being due to capital gains. And this is taxed in the highest marginal tax bracket at an effective rate of 18%. Also, very important is that a portion of this could be invested in a tax-free savings account, but the limit, of course, is 36,000 a year and 500 over your lifetime. I've got a tax-free savings account video that you can look at to understand that a little bit better. But in this case, I'm assuming that the TFSA is not being used. So it's rather just a normal brokerage account, and the entire investment will be subject to capital gains tax. For the retirement annuity, the third paid out as a lump sum, up to 550,000 is not taxable, But then above that, the tax rates increase to 27% and then 36%. And these products are what I normally call restricted tax smart investments, which means you get some tax advantages, but it restricts the way in which you can invest it. Sometimes this is good. If you don't have any idea of how to invest, then a retirement annuity kind of restricts you in terms of not taking too much risk and also only withdrawing some of that at retirement age, not withdrawing all of your money. But of course, my approach is to educate you enough so that you can actually take control of your investments, so that you are able to split your investments between low and high risk and also adjust it as you age, but also so that you don't spend all of your money when it is accessible to you, because in a brokerage account, your money basically is accessible to you and you could spend it all theoretically tomorrow, but not if you're a Money with Carla follower. So now we want to compare the investments after tax. On the RA side, it's a little bit more tricky and I had to make some assumptions. And this is purely because 1/3 is subject to tax when it's paid out as a lump sum, and the other amount will be subject to tax when it's paid out as a living annuity. And that really provides you like an income when you retire. If we project based on the returns assumptions I mentioned, what these investments would look like over a 30-year timeline, and this is after tax, the ETF investments, I'm assuming, will be subject to capital gains tax. The ETF projection is based on the MSCI World Returns. And you will notice that in year 19, there is a break-even point. And this means that even though Nora was able to invest significantly less because of the higher tax she had to pay, that after 19 years, she actually becomes better off because her investment was able to earn superior returns because she was able to take more risk. And then if we project this over a 30-year period, after tax, this could mean a difference of 2 million. And this is only on the 350,000 that was invested. This does not consider all the subsequent years RA contributions that would be made and the difference that could result in. On the S&P 500 return assumptions, this looks significantly different. You will notice that there is a break-even point in year 10. And that means despite investing significantly less due to the higher tax that she paid, Nora is better off after 10 years because her investment had a superior return. And if we look at these projections over 30 years, that could mean a difference of more than 12 million after tax. Of course, I have to remind you, no guarantees, just assumptions. But this is an important concept to understand because it could be better for you to not take the tax saving, which comes with a restriction around how you're allowed to invest that money, and rather go into a normal brokerage account, which gives you complete freedom around how you're allowed to invest it. And this is despite having a significant tax saving of 45% of the RA contribution, as I've mentioned earlier. Now to establish the 19-year rule. Before we do that, if you're still watching, you're probably really serious about making smart investments. And I think you will enjoy my free 5-day mini course. Sign up using the link in the caption. For my 19-year rule, I'm using the MSCI ETF return assumptions. And this is because that's the benchmark for the return on the global stock market. And also, using the S&P 500, I feel would be a little bit too aggressive. I prefer to use the global benchmark. So now I'll use the charts I showed you before, using the after-tax amounts on the two investments, and I'll replace the years with your age. So let's say in the case that you're 35 years old and you're now choosing between an RA investment similar to the one I've shown before or an MSCI World ETF, based on the returns assumptions we're using, then you'll notice after 19 years at the age of 54 that the blue line now overtakes the red line. And that means it could be smarter at this age to go into an MSCI World ETF, especially if the retirement age is 65. RA products could be accessible to you before the age of 65, but I'll discuss that just in a bit. If you're 45 years old, the chart could look like this. You'll notice after 19 years at the age of 64, the blue line overtakes the red line. And this is the break-even point. So this is how I established the 19-year break-even. And this is not financial advice, by the way. This is really just trying to empower you to ask some critical questions. But the 19-year break-even point then means if you are further than 19 years away from retirement, I want you to critically question whether a retirement annuity is the best investment for you, despite the tax advantages that comes with it. And to round that up, we can make it 20 years, which means if your retirement age is 65 minus 20 years, that's age 45. If you are under 45 years, then I really want you to question whether that's a smart investment for you. And if you're above 45 years or within 20 years of retirement, then it could be a smart investment. And the reason I'm saying this is not financial advice and this is not a hard rule, please do some further research before you just implement this, because there are some other factors to consider. Like a retirement annuity restricts access to the products and it kind of forces you to keep this money until you're ready to retire. You can start accessing it at the age of 55, but on the other side, a normal brokerage account is always accessible to you. And therefore, if you're not smart with your money and not smart with your investments, then it could be tempting to use that money before retirement. Also, a retirement annuity could be smart for estate planning purposes, because if you pass away and there is still value in your retirement annuity, then it would not be part of your estate. It would be paid out as a death benefit. And this could mean saving 20% or 25% on estate duty. But also, the investments in your normal brokerage account could exceed the RA investments by much more than 20 or 25%. So even after the estate duty is applied, it still could be smarter. And last, but definitely not least, I've seen some horrible RA products that have such high fees attached to them. Remember, these assumptions I'm using is based on low fee investments. Even on the RA product I showed was a low fee product. If you're paying 2 or 3% of effective annual cost fees, then the outcome for you could look significantly different. I feel like I say this in every video. Check on your fees. Even if it's 1.5% or 2 or 3%, this can have a significant difference on your investments in the long term. And then as a final reminder, this is not financial advice. This is only for educational purposes. My calculations could contain errors, and there could be some data that I did not consider or something that I did not take into account. Do your own research before relying on anything I share. Please let me know in the comments what you got from this video. I'd love to hear from you. See you next time.